Hi, I'm Manish and today, we are going to talk about one of the most important topics in personal finance, investing. There are many myths and misconceptions about investing that can prevent people from taking advantage of its potential benefits. In this video, we are going to go over some of the most common myths about investing and why they're simply not true. Myth number 1, you need a lot of money to start investing. One of the biggest myths about investing is that you need a lot of money to start. This simply isn't true. In fact, there are many low-cost and even no-cost options for investing, such as index funds, that make it possible for anyone to start investing, regardless of their financial situation. Myth number 2, you have to be an expert to invest. Another myth about investing is that you have to be an expert to do it. While it's true that investing can be complex, it's not necessary to have a deep understanding of the stock market to be a successful investor. With the help of a financial advisor, anyone can start investing and see good results over time. Myth number 3, investing is too risky. Some people believe that investing is too risky and prefer to keep their money in savings accounts. However, while there is always some level of risk involved in investing, it's important to remember that the stock market has historically provided high returns over the long term compared to savings accounts. So, while investing can be risky, it's also one of the best ways to grow your wealth over time. Myth number 4, you have to time the market. Another myth about investing is that you have to time the market to be successful. In other words, people believe that you have to buy and sell at the right time in order to make money. However, this is simply not true. Timing the market is nearly impossible, and it's much more effective to simply invest regularly and hold on to your investments for the long term. Myth number 5, active management always beats passive management. Finally, some people believe that actively managed funds always perform better than passively managed funds, such as index funds. While this can sometimes be true in the short term, over the long term, passive management has been shown to perform just as well, if not better, than active management. Conclusion. In conclusion, these are some of the most common myths about investing. By understanding the truth behind these myths, you can make informed decisions about your investments and take advantage of the many benefits that investing has to offer. Thank you for watching.